Welcome to the CASA 4x4. This 4x4 is driven by Grahame Dixie, Executive Director of Grow Asia. The 4x4s are 4 expert viewpoints with 4 minutes to share their views. What is the case for investment in agriculture in developing markets? Is there a difference between international and local investors in this respect?
The thing around the agricultural sector is it's a different kind of market. It's one which has been growing. Certainly in our region, which is Southeast Asia, we're getting a compound annual growth rate of about 6.6%, which effectively means the amount of money that is being spent on food will double over the next decade. So you've got a rising market and similar sort of figures in Eastern and Southern Africa. But it is a risky area. It's a sort of high risk, high reward area, agriculture. So that the important things are to know your market, to have some sense of what your production will be, because you're constantly battling with weather and external events, but also with world prices which can go up and down. So it's a less secure market. It's more volatile, but it's an expanding market with an expanding demand and a very steady demand. There is a difference between international investors and local investors, and I think it's a question of scale. That generally, when you start these kind of operations with outgrowers, there is a lack of trust between an outgrower and an agribusiness, and it is more pronounced with a large multinational company. So the large multinational company is terrified of what they call side selling, that they will provide those inputs, they will provide some credit to those outgrowers, and the outgrower will then be approached by a traveling trader who will offer him a slightly higher price, and he thinks, well, I can get that cash quickly and I won't have to repay the loan, and I've got a wedding coming up, how easy it is for him to side sell. On the other hand, the grower is terrified of the agribusiness. He's terrified because they have so much more negotiating power, what the world prices are, and he's terrified he's going to be ripped off. And they will probably feel a bit more comfortable with a local business. And their local business obviously has the advantage of language and understanding culture in a more subtle and a more nuanced way. So that's the kind of clear difference between the local business and the multinational company.
Why should investors care about smallholders? Aren't business models that rely on them less efficient, more complex, and ultimately less profitable?
In many countries, there are only smallholder farmers, or there are very, very few large farms. So that the agribusiness community is therefore looking for ways that it can work with smallholder farmers. The second thing is around smallholder farmers. They do have some comparative advantages. They are much more cost effective with highly labor-intensive operations. So you can see that in Kenya, where the fine beans are continually grown by smallholders because of the labor input in that. Crops like cocoa is pretty traditionally been a smallholder crop. So has rice, if you look to Thailand and Vietnam. So that there are some crops which you have some inherent advantages of the smallholder. But it does mean that you need to work out new ways of doing business. And there are certainly a number of companies who really specialize in it and have made it work. One of the biggest ones is Olam, who are major traders and have 4.7 million outgrowers who they specialize in the sourcing of soft commodities from networks of outgrowers. Or you've got CP which originated Thailand and originated a thing called a business integrator model, so that in Thailand you can't buy land. So what they do is that they need to work out a way to work with smallholder farmers. So they do a contract farming basis, which is very much with broilers, that you provide day-old chicks, you provide technical advice, you provide feed, but you guarantee to buy back their production. And that builds trust over a period of time, and it circumnavigates the issues of them not having that land. And the other piece around it is this one, which is actually often using a network of outgrowers keeps your own capital costs lower. You don't have to buy that land, and it keeps your working capital requirements lower because you've got your outgrowers making a portion of their investment in terms of tractors and labor time and so on and so forth, so that it is a lower cost business model. When you're dealing with smallholder farmers, the experience is that you can't afford to expose them to financial risk. And studies have shown that that statement about, when you invest, you should only invest what you can afford to lose. And if you're a smallholder farmer, you haven't got very much to lose. So you need to have a business model which is of low risk as you possibly can. And one smart way around that is what's called the repeatable business model. There's a book about it called The E-Myth Revisited. But quite simply, what it says is that businesses fail at a very high percentage, but franchise models or repeatable business models have a much higher success rate. And this is one of the smart ideas you see in agricultural investing. Amul in India, which is probably one of the greatest examples of a milk cooperative buying literally from millions of smallholder farmers, has got a repeatable business model. And what that comprises is a milk route, that they realize that you need to pick up around about 6,000 litres on a milk route, but you can more or less break even at 3,000 litres. So the consequence is everyone has a very clear mental image of where they will take their milk route. Can they get enough farmers to be able to deliver a minimum of 3,000 litres of milk? This may involve 3 investments in 1,000-litre chilling plants, for example. And that they bring people in and they call them spearhead groups to work with the farmers around that milking route to explain to them what's happening, how they can lift their yields, what the measurement is of butter fat content, etc., etc. So everyone understands it, everyone understands the numbers involved, and it means that you don't stumble around and make mistakes. The integrator model that I alluded to with CP and you find elsewhere in the world is also an example of that, where things have been able to work. So, and in fact, if you look at the Kenya horticultural industry, people knew you needed to invest $1 million if you were going to start a rose farm. You needed to plant these sort of varieties. Or another example is catfish farming in Nigeria, which again, a repeatable business model, 2 different systems, one costing about $15,000, another costing about $100,000, that in around about 18 months you would repay that investment and internal rate of return. But so everybody knew the systems and how much water needed to be circulated. So these are some of the smart ideas that people have developed to reduce the risks, both for these outgrowers involved, but also for the business.
What would you say to private sector investors who are keen to learn the how-to aspects of good investing in agriculture?
What we find about the private sector is there is a myth that they know everything. What we've found is they're just really like sponges. They want to learn. And what they want to learn is not to make the same mistakes as other people, and they want the how-to. They don't seem terribly interested in concepts and so on and so forth. So where would they get that information from? Well, I think that there was a thing called the International Agencies Working Group, which comprised the World Bank, UNCTAD, FAO, and IFAD, who decided to do a series of studies in order to bring from the ground what were the lessons of what works and what didn't work. And one of those was a very interesting study which looked at 178 investments by the Commonwealth Development Corporation in agriculture over a 50-year period, and they opened all their books. So each of those cases were analysed about whether it's a success or failure, and it brought into the public domain 5 or 6 lessons that hitherto had not been available or had been sort of opaque. And they talked about the risks. They talked about how often the low percentage of businesses which initially covered their cash flow, so they often actually sell the business. And they invest $10 million, they sell it for $5 million to someone else and go away with the tail between their legs. And either that investor or the second investor after that, who have bought these distressed assets, but with that foundation, have managed to turn it to a profitable business. The other thing turned out that there were certain examples of business models which were less risky, so that estates, large farming operations, were more risky than a nucleus estate. A nucleus estate is when you have your processing operation and you have a farm surrounding it. And for the financier, he likes that because it means that you've got a guaranteed raw material supply to ensure that your plant will operate. And then from out of that, you have your network of outgrowers. And that proved to be one of the least risky of the operations, partly because they were sensible enough not to make investments with outgrowers until they were pretty sure of the business model. And the smallholder operations was quite risky, not too bad, it depended. And then the other one that came out of that one was that every so often, one of those investments is really transformative. And it, an example would be in the CDC case was that they introduced smallholder tea production in Kenya. Now, smallholder tea production is the major source of supply, and the estate production has been in decline. So those were kind of useful lessons that they started giving people. If you were an investor, it's the first time that you got a sense of what do these investments look like, what are the successes and what are the failures. The second one, which I thought was really fascinating, was there was a thought that if you applied responsible investing to 6 new investments, would this prove that this was a good thing to do? But actually, when you thought about it deeply, you realized, well, it's going to take 8 or 9 years. So actually, we need to accelerate that process. And somebody came up with the brilliant idea that they presented to that group their business case, but what they had done was to retrofit the principles of being a responsible investor to it. And so the approach was to apply to existing mature agri-businesses and see, in retrospect, how responsible had they been? How many of the sort of classic processes that you see in responsible investing had they applied? And then they went to the communities around them and essentially asked them, how was it for you? Third piece, I think, which is really useful, is that the World Bank and UNCTAD particularly looked at those issues, and they came up with 24 working notes. And in that, it highlights and saying, as an investor, these are the things you can do to overcome this issue. So I think those would be a really good starting point because they're practical, and it's field-based research rather than theoretical research. It's the kind of thing which the Harvard Agribusiness School doesn't teach you.
What are the rookie mistakes made by new investors in smallholder-led agriculture?
When we looked at what tended to go wrong, was that the new investor tended to cobble a project together. So he would scratch around, or she would scratch around and find a bit of land, and then try and get permission from the government, and then sort of look at what might be able to be produced there, and then look if there was a market opportunity, and then scratch around for some finance. It's a sort of, it's not necessarily a recipe for disaster, but it doesn't help. And you often find that rookie investors make those kind of mistakes. They're desperate to get a bit of land, and they try and build it up incrementally, whereas the better investor has a deeper pocket, he has a bigger vision of what he's going to do, he really knows where his market is. And I've alluded to some of the places where you can learn what to do from the work with CDC, the retrofitting of principles, and the notes for investors done by the World Bank and UNCTAD. But there's another thing that we've found very interesting, and that is that you learn more from failure than you do from success. And but everybody wants to talk about their success. They don't like talking about their failures. So one of the ways that we have tried to get around that is that we now have confessionals. And what that means is that we create a safe environment, Chatham House rules, and bring in maybe 13 to 15 investors, or discuss some of their projects or investment projects, or we did one recently about gender, and to enable them to say, this is where we went wrong and this is what we learnt from it. And it has been quite remarkable how in that safe environment people are prepared to talk about those, what are the failures, and share best practices. And so much of the learnings happens when you hear the authentic voice of someone that's made that mistake, found a way around it to impact on another person. And that might be a way that we could strengthen the thinking of rookie investors, to be able to learn from those that have made mistakes and are quite happy to share them. You know, the ICR reports, or the project completion reports, that they are written to a formula, and how often is it that you've read that and then you go to the person who led that particular project and you discover all sorts of learnings. You know, an example in this area is how a complaint can amplify into something which really festers and creates a disharmony between local communities. So, you know, if the women in a village just outside the agricultural investment operation are frightened when they see how fast the tractor driver is driving the tractors down the main street of their village because of their children playing in the roads and so on and so forth, they want that message to get across. So you do need a consultation platform for that to happen. You do need people to be able to respond, because often people, when there's a complaint, they don't want to engage with it. It's the worst thing you can do. That actually, if you engage and say, okay, I'm going to tell my tractor drivers not to drive, you know, that they're only going to drive at 15 kilometers an hour through the village, and they see that, then it builds up that harmony with the local community, and they know that you respond. Because if you don't, it festers. And when they feel that their voices are not being heard, you know, it ultimately can end up with some of these disastrous stories where they kidnap junior managers in order to try and get their message across. But you won't find that written up in any report about an investment, but it is those sort of things that you learn what really works.
Visit the event page of the CASA website to see recordings of other expert viewpoints shared in the CASA 4x4s and webinar series.